Good evening. It's my privilege to have the opportunity of talking about Reliance's results again. As you will hear from me over the next few minutes, we had an absolutely brilliant quarter ended June 30th, 2016. But before I get on to talk about the specifics of the quarter, let's first look at the macro that we operated in during the last quarter. It's safe to say that commodity markets started to see recovery from the volatility that we had seen last year. Crude oil averaged about $46 in the last quarter, up nearly 50% from the bottom of just under $30 per barrel. Gas prices today at between $2.6 to $2.7 per million BTU are nearly twice the low that we saw between $1.4 to $1.5 per million BTU. Closer home, we saw stability in exchange rate at roughly 67 average for the quarter, both for this quarter and the previous quarter. The more interesting part is really about global oil demand. As you might recall, we saw nearly 1.7 million barrels of oil demand growth in 2015. The latest estimates for 2016 and 17 have been revised up, and it is now estimated that we will see 1.4 million barrels of demand growth in 2016, followed by perhaps 1.3 million barrels in 2017. This growth of over 4 million barrels of oil demand in a successive period of 3 years really bodes well for the refining industry. It will have its quarter-on-quarter volatility, but I think structurally producers are in a good place. Coming close to home, we saw good growth in demand both for our refining as well as our petrochemicals businesses in this quarter. Refining product growth was 7.8% across both diesel as well as gasoline. Gasoline was up nearly 10% Y on Y, whereas diesel demand growth was also strong, 4.7%. Polymers is where we saw the most demand growth in our petrochemical segment, 12% growth year on year, a strong 11% growth in polypropylene, and a near 22% growth in PVC, which goes into household products, construction, and so on. With that, let me talk about our financial results. I want to first state that we have made the full transition to Ind AS as is required, and the results for this quarter and the comparison for the same quarter last year as well as for the full year March 2016 are all under Ind AS. Revenue this quarter was about in excess of 71,000 crores, up nearly 12% compared to sequential quarter, and a lot of that is because of the increased and better commodity price outlook. We had records across all earnings parameters. PBDIT at 13,589 crores, up 16%, and a record. PBT 9,658 crores, record in the company's history, up 21%, and consolidated PAT at 7,113, also a record for the company. Standalone also with 7,548 crores, we had record earnings. So both on standalone and consolidated, we have posted record earnings in this quarter. Return on capital employed has of course also improved. On a gross basis, we have return on capital employed of nearly 12%, and adjusted for capital work in progress, return on capital employed is well in excess of 20%. This is really gratifying to us because when you look across the international large majors, a single digit return on capital is what we have seen in the last 12 months. So the quality of our assets and their earnings capability is clearly stands out well in the international peer group. Two other measures. Capex during the quarter was nearly 27,000 crores. Between 8 to 9,000 crores was spent in our projects at Jamnagar, and we spent about 12,000 crores in our digital services project. Net debt at the end of the quarter was about 96,000 crores, and at this level, this is consolidated debt net debt level, and at this level it is less than 2.5 years of our current exit rate in terms of our cash profits. With that, let me move on and specifically talk about our refining business. The first piece of good news is that we had a gross refining margin of $11.50 per barrel. This is higher than last quarter despite a sharp contraction in Singapore refining margins. The spread of $6.50 per barrel over Singapore complex is also an 8-year high, and I will talk about the reasons why we have done well very soon. But let us just spend a minute on why the refining margins are soft elsewhere. In our part of the world, gasoline margins were much softer, down almost $4 a barrel compared to previous quarter. Naphtha was softer, much softer than the previous quarter, and fuel oil margins really were much weaker than the previous quarter. As when we look at our performance, we also compare with US Gulf Coast as well as European refining margin environments, and even in that comparison, US Gulf Coast at about $8 per barrel and European at about $4.50, we have done well across all comparisons. There are 5 reasons that I would highlight as to why we have done well in refining. The first and foremost is that middle distillates, which includes gas oil and aviation fuel, and which account for nearly 45% of our product slate, were better by nearly $1 per barrel. Secondly, our crude sourcing spans really fuel oil linkage, Brent Dubai linkage, and Arab light heavy linkage as a complex refiner. So with weak fuel oil, a narrower Brent Dubai and a stable Arab heavy differential, we benefited on across all those 3 parameters and were able to source crude very competitively in this quarter. Risk management is an integral part of our approach to our refining business and managing the earnings, and this quarter we benefited from very strong risk management both across product and crudes. Fourthly, domestic absorption increased, and we now have over 1,000 retail stations open. The productivity of our retail stations is between 30 to 35% higher than the industry average, and we were able to place 21% more volume of both diesel and petrol in our retail stations as compared to the previous quarter. Finally, we did have a build-up in inventory towards the end of last quarter in preparation for the shutdown, and we were able to liquidate that inventory at better prices than at the end of the last quarter. So that's really what underpinned our record performance from our refinery. Moving on to our petrochemical business. In this business, we had flat revenues as compared to both previous quarter and last year. Despite flat revenues, we had a standout quarter as far as earnings are concerned. EBIT at 2,806 crores is not only up 20% Y-on-Y, is a record for this business. EBIT margin at 13.5% is an expansion of nearly 2.3% over last year and is also a near record for this business. We have had EBIT margin expansion for 9 consecutive quarters in our petrochemical business. So this validates really the strength of that portfolio. It also speaks about the benefits of integration, as our petrochemicals and refinery businesses are completely integrated, which you know. When we look at the demand environment, we saw, as I said earlier, a strong growth in the polymer segment. We saw 6% domestic demand growth for polyethylene. We saw 11% domestic demand growth for polypropylene and 22% domestic demand growth for PVC. So a strong domestic market which is deficit and which is able to absorb everything that we produce really gives us the opportunity to get expanding margins and have 100% plus operating rates. When we look at the margin environment, there are 4 real reasons why we got better margins in our petrochemical business. The first one was naphtha really lacked crude oil. So naphtha is one of our key feedstocks, a principal feedstock, and the weakness in naphtha really allowed us to see better margins across the chain. The second reason is propylene, which is also a key input, was also soft this quarter. A combination of new capacity of PDH coming on stream and some maintenance in polypropylene units. So we benefited from a widening polypropylene-propylene delta. I talked about the fact that we were able to place 100% of the production both in domestic and export markets, primarily in domestic markets, which gave us better margins. And finally, we were able to even see a slightly better margin environment across our polyester chain. So demand growth, placement in India, softness in feedstock, all this added up to a record margin environment for petrochemicals. We now move on to upstream. We do see some improvement in our upstream business, and the financial numbers are slightly better than last quarter. It still is not material to our business, and at EBIT level we were negative in this quarter, though slightly better than previous quarter. As far as production is concerned, domestic gas production at about 26 BCF is 19% lower than previous year from natural decline. In our shale gas business, production was nearly 45 BCF, but also lower by 10% as compared to previous year. You might recall that given the tough commodity environment, along with our partners, we are not engaging in any development activity right now. So the decline is really resulting in lower production. The ray of hope is that with the improvement in commodity prices, unit realization in our shale gas business is up 26% sequentially, but is still more than 20% lower where it was a year ago. Our CBM investments are now being tested, are now in the pre-commissioning phase. So we expect to see production from CBM in the near future. Lastly, let me talk about retail. We have had another standout quarter in retail. Revenues exceeded 6,600 crores. EBIT margins stayed flat. We now have nearly 3,400 stores across 679 cities. We opened 138 stores in this quarter, and now our footprint is well over 13 million square foot. We are now starting to execute our omni-channel strategy, and you will see that as we offer AJIO both in-store and online. We have been named Retailer of the Year, and we have also been now with our offering of Life smartphones, we now own among the top 3 smartphone brands in India. And this is something that we expect to continue to grow in the coming quarters. That brings me to the end of this update. Thank you very much and wish you all a good evening.